Good afternoon, everyone. Welcome to the TheoTrade evening video. I'm Blake Young. Today is May 1st, 2023, and today we're going to be talking about Manic Manager's show. Our troubles ain't over. Let's jump right into the Institute Supply Management Purchasing Managers Index. The Purchasing Managers Index is an index that measures what the managers of manufacturing facilities are buying, what they're buying, what they're paying for services, etc. And the main thing we're looking at here is that any value under 50 is considered contraction, market contraction, economic contraction, showing that we don't have a lot of growth. And if we zoom in over here and look a little closely at the data that is in here, you're going to see that we've gone in a continuous slide of manufacturing slowing down. So yes, this last month is showing an uptick, but it's still below 50, so it still shows the economic compression, market compression, pushing this back down. And as we look at the 47.1% level versus the 46.8 expected, that again would be still a contraction and slight improvement from the previous month. But if you look at the pattern and the trajectory, we've started this pattern all the way back in 2022. 2022, January 2022 was the beginning of this, so we are now at all the way over here. We're now at a 16-month decline in manufacturing data, compression that's going on. Now, what's driving this? We might think, oh, it's finally we're seeing destruction of demand as the Fed has indicated they wanted to reach. But if we look at the ISM manufacturing prices, if we look at the data, what they're paying, we do not have this under control. As we look at this, this would be compression, this would be fighting inflation. And as we look a little closer, the Institute of Supply Management pricing data turned the corner, stopped falling in January of this year, and has improved 4 of the last 5 months. And so we're seeing a significant improvement in manufacturing pricing. And when I say improvement, I'm seeing inflation. We probably shouldn't call that improvement, where we're still fighting inflation. If this was a situation where manufacturing had gone negative or compressed and we were near the 2% mark, 3% mark as far as inflation, 3 to 5% as far as GDP, this would be a strong indication that the economy is doing well, and we should be looking for bullishness and growth and expansion, kind of like what we saw back through here. But right through here is just showing us higher prices while manufacturing remains in a compressed state. So if we were to take a look at industrials and basic materials as the primary ETFs that drive this data, you can see that the industrials are still on a climb here, 3 days in a row, pushing very strong up to the top. But this resistance area is also an area that I would be very aware of to take profits, possibly reverse the trades out, because you can see we've rejected this level over and over and over and over again. Now some of them have pushed beyond here. I actually like this one a little bit better because we have good reversal points and kind of pivot candles at about 102 rather than going all the way up to 104. And so I don't know if we're going to get all the way up to 104. We might turn around about 101.20 to 102. And so looking at industrials, we can see that yes, there's growth here, but there's a lot of overhead pressure. If we look at basic materials being what they're paying for from the manufacturing perspective, what they're going to be buying, and you can see that we're not near the highs. We're actually still in this decline. And so basic materials, they're not making money on these higher prices. Basic materials manufacturing facilities, they're not making money at these higher prices. So basic material is still weakening even though prices have been higher. And so looking for a rollover somewhere near 82 versus 85, I just don't even see us getting anywhere close to 85. But if we're looking at industrials, we might take some time and say, okay, can we look at manufacturers? Yes, we could. Should we look at maybe the bigger manufacturers? One of the things that I'm watching is Boeing. Boeing, I mean, we can do Lockheed Martin as well, but I like Boeing because we know that there's a slowdown in Delta and United and really all the airlines and all the travel companies that we've seen across the board. So if they're not in a growth state, not in recovery, they're nearly half the cost that they were earlier this year, then they're not going to be ordering additional planes. They're not going to be ordering additional materials. So I'm really looking at Boeing as maybe something that is overly priced, too high priced, and if manufacturing is showing that slowdown and higher cost, at what point are we going to see this reverse? Now, they did have less loss than before, but if you recall, we talked about earnings back in January, that they had a massive order from Delta that they kind of pre-bought. They pre-bought a number of airplanes, and so they've ordered a huge quantity, but that just means they're not going to order them later. So as we look at our earnings over the last 2 quarters, we were expected to come in at 5 cents. It came in at a loss of 175, and over here you can see we were expected to come in at 98 cents, and it came in worse at 127. So here we are losing money, a lot worse than what analysts expected both quarters. And yet we're up from the lows of just 6 months ago, from 143 to 206. So this is one that I'm looking for bearish moves. I'm looking for reversals. I'm looking for kind of a topping pattern in Boeing. Now again, we can look at Lockheed. Lockheed doesn't have that same overbought appearance. You can see they're actually making money and more defense contracts versus something like Boeing. So Boeing's probably the trade that I will be watching for. Possibly a butterfly, possibly a bearish selling of call premium or call verticals, and maybe using that to fund a put, because I don't see that this is maintainable up here at these high levels with we've had so many misses and such slowdowns in their clientele. One other that I am considering is Train Technologies, again in the industrial sector, and strong, huge bullish move today, pushing up through these levels. I'd be watching for a move up into the 192 to 195 area, and then start looking to sell premium up there, whether again with a unbalanced butterfly or selling call premium or call verticals and funding a put to see if we can get back to 175. And I do think there's going to probably be a pretty good move there. And it looks a lot like Boeing as far as its price pattern, rallying from 6 months ago and approaching its previous highs. Well, that's going to do it for me. Thanks for watching. We'll talk to you again next week.